What's behind the shocking $40.8 billion surge in consumer credit this December? Profit and Peril, where we break down the market's big moves. Today, it's all about the December consumer credit surge that caught everyone off guard. Remember, this is not financial advice, but you need to know why this matters for your investments. Federal Reserve reported a massive $40.8 billion increase in total consumer credit for December. This spike follows a $5.4 billion drop in November. It's the biggest percentage gain since June 2022. Revolving credit, mainly credit card debt, soared at a 20.2% annual rate. Compare that to November's 12.1% drop, and you've got a dramatic turnaround. Here's the part nobody's talking about. This significant uptick in consumer credit usage can be attributed to various factors, including post-pandemic economic adjustments, increased consumer confidence, and the holiday shopping season. Historically, such sharp increases in consumer credit have often preceded periods of economic growth, but they can also signal potential financial instability if not managed properly. In the past, similar surges have led to cautionary tales, where consumer debt burdens eventually stifled economic expansion, leading policymakers to tread carefully between fostering growth and curbing excess. But the Fed isn't done yet, and that's where it gets complicated. Let's dissect the numbers. In December, credit card usage exploded. Consumers are spending like it's 2019. But what's driving this? Holiday shopping, inflation pressures, or a more sinister reliance on credit to make ends meet? Historically, December is a peak shopping season, traditionally causing spikes in consumer spending due to holiday purchases. Here's the part nobody's talking about. However, the context of current inflationary pressures cannot be ignored. With the cost of living rising, many households may be resorting to credit cards, not just for gifts, but for everyday expenses. This trend is a double-edged sword. While it boosts retail sales and economic activity short-term, it also increases household debt levels, which could lead to financial strain if income growth doesn't keep pace. Meta, Ford, Tesla, and Apple are all influenced by consumer spending. High credit usage can mean more sales for Apple gadgets or Tesla vehicles, but it's not all rosy. The disconnect between stock market optimism and consumer sentiment is widening. Stock valuations soar, yet consumer optimism plunges. Here's the part nobody's talking about. Joe Sadel from JP Morgan notes this divergence is unusual. Historically, consumer perceptions and economic indicators were aligned. So, what's fueling this credit surge? Increased consumer spending could drive short-term economic growth. But here's where it gets dangerous. The current economic landscape is characterized by a unique set of challenges and opportunities. On the one hand, the surge in consumer credit indicates robust consumer demand, which is essential for the growth of companies heavily reliant on consumer spending such as Meta and Apple. This demand can lead to increased revenues, higher stock prices, and positive market sentiment in the short term. Tech companies in particular may benefit from increased sales of consumer electronics and digital services as consumers continue to prioritize connectivity and entertainment. That's not the whole story. However, the broader macroeconomic environment is fraught with risks, including potential interest rate hikes by the Federal Reserve to combat inflation. Such moves could increase borrowing costs, making it more expensive for consumers to service their debts. Additionally, a prolonged period of high consumer credit usage without corresponding income growth could lead to increased default rates, affecting financial institutions and potentially leading to tighter credit conditions. This scenario would negatively impact sectors reliant on consumer financing, such as automotive and retail. And that's the key detail. The widening gap between stock market performance and consumer sentiment suggests that while investors remain optimistic, possibly buoyed by corporate earnings and innovation prospects, consumers are feeling the pinch of higher prices and economic uncertainty. This divergence could lead to volatility in financial markets if consumer spending falters, or if economic indicators suggest a slowdown. Therefore, while there are opportunities for profit, the underlying risks cannot be ignored. Investors must remain vigilant, balancing optimism with caution and continuously monitoring economic indicators and consumer behavior. Sector-wise, tech and automotive stand to benefit from higher consumer credit. Watch for increased volatility in these sectors. But be cautious. Markets may react unpredictably as consumer debt levels rise. The tech sector, driven by consumer demand for the latest gadgets and digital services, could see a boost in sales figures, particularly for companies like Apple and Tesla, known for their innovative products. Here's the part nobody's talking about. However, as consumer debt levels increase, there is a risk of volatility in stock prices, as market participants react to changes in consumer spending patterns and economic data. Automotive companies, such as Ford and Tesla, may experience fluctuations in sales, as consumers weigh the benefits of purchasing big-ticket items against the burden of additional debt. Historical data shows that sectors closely tied to consumer financing often experience heightened volatility during periods of economic uncertainty. But wait, making it crucial for investors to stay informed and adapt their strategies accordingly. The surge in consumer credit raises red flags. As debt levels climb, so does the risk of higher interest rates. Lenders may tighten their belts, impacting borrowing costs. Long-term, rising consumer debt threatens financial stability. Picture stormy skies over a market teetering on the edge. Here's the part nobody's talking about. Historical precedents show that unchecked consumer credit growth often leads to financial instability. As seen during the 2008 financial crisis when excessive borrowing and lax lending standards contributed to a market meltdown. If interest rates rise, consumers may find it challenging to service their debt, leading to higher default rates and potential strain on financial institutions. Furthermore, elevated debt levels can dampen economic growth by reducing consumer spending power as more income is allocated towards debt repayment. This scenario could result in a vicious cycle of reduced economic activity, but wait, and increased financial stress, highlighting the importance of monitoring credit trends and implementing sound fiscal policies to mitigate risks. Looking ahead, we expect short-term boosts in consumer-driven sectors, but tread carefully, balance optimism with caution. As consumer credit climbs, keep an eye on interest rate movements and market reactions. The short-term outlook for consumer-driven sectors appears positive, with increased credit usage likely driving sales and revenue growth. Here's the part nobody's talking about. However, the potential for interest rate hikes poses a significant risk to sustained economic expansion. Investors should remain vigilant, monitoring economic indicators such as inflation rates, employment data, and consumer sentiment. By balancing optimism with caution and maintaining a diversified portfolio, investors can navigate the complexities of the current market environment and capitalize on opportunities while mitigating potential risks. So is this a moment of profit or peril? The December credit boom offers opportunities, but the underlying risks are real. Stay informed and adjust your strategies accordingly. The key to navigating the current economic landscape lies in understanding the factors driving consumer credit growth and assessing the potential impact on various sectors. By staying informed and remaining adaptable, investors can position themselves to take advantage of opportunities. Here's the part nobody's talking about. While mitigating risks associated with rising debt levels and economic uncertainty. Liked what you heard? Hit subscribe for more market insights. And don't forget to ring the bell for notifications.